Hey everyone, this is Buck Joffrey. Of course, most of you know me, but if you don't, let me give you a little bit of my background. So I am a board certified head and neck surgeon by training. I very quickly went into another route, became a serial entrepreneur, and now I'm a professional investor, financial educator, and podcaster. So if you haven't seen it, check it out, Wealth Formula Podcast. For high-paid professionals, I think we've got one of the best products out there in terms of education. And anyway, what I want to talk to you about today is something that, quite frankly, I couldn't believe when I found out about it for the first time, that I didn't know about it. That literally, if somebody had told me about this 20 years ago, that I feel like I'd be so much better off today. And that even though I've done really well financially, I mean, I'd have probably another zero after my net worth at this point, had I known that this product existed. Now, let me ask you guys a question. Now, what if you could invest your money knowing that it always had a positive trajectory and was not going to vanish with the next stock market crash? And what if you were able to grow that money tax-free? Now, what if that money were actually protected from lawsuits and creditors? Would you sleep better at night? You probably would, right? And at this point, a lot of you might already be sold on an idea like this and want to know more. But here's what really blows me away about this concept, and I want you to listen to this carefully. This is a concept that allows you to invest the same money in two different places at the same time. That's right. You didn't hear that wrong. This is taking the same hard-earned money that you have, investing it in two places at the same time, and creating more overall returns. That's called double dipping. And that's the kind of thing that the wealthy do on a routine basis. And I'm discovering more and more of these secrets all the time. And this one is so urgent. I wanted to make sure that I got the best in the business to explain this. So I have got two guys here, Christian Allen and Rod Zabriskie, who are going to tell you about a concept that we call wealth formula banking. Hey, welcome, guys.
Hey, thanks for having us. Like you said, I'm Christian Allen. My partner Rod Zabriskie's here, and you're right, Buck. It's a pretty incredible strategy that more and more people are starting to learn, but still relatively unknown. I would say that I hear that same sentiment that you mentioned, just, hey, if I would have known about this 20 years, I would have been a lot better off. And I think there's a lot of truth to that, because it's just such a powerful strategy that really helps people. And maybe to kind of kick things off, let's talk about who this strategy really is for and what it does. So the first thing to note is that this is for your active investors. These are for your real estate investors, your business investors, your syndicate investors. I mean, all the types of things that we talk about. This concept is ultimately going to have a huge impact for any of you that focus on active investing. And then the second thing here is that, in essence, we're working to replace the bank. We need a more effective place, right? So we're going to talk about how we can use this strategy as a much more efficient alternative to saving money up in the bank and then deploying it into our investments. So that's really important. And what I want to do is I want to go through and break this up into two parts. I want to talk about the vehicle that we're using. This might surprise some people. And then I want to talk about and focus most of our time on the part that's more exciting, and that's the actual strategy of wealth formula banking. So back to the actual vehicle, we're using a product that's been around for hundreds of years and has an incredible track record of performance. We're using whole life insurance, but we're not using it in the traditional sense, right? We're going to be focusing not on the death benefit, even though there is value there. We're rather going to be focusing on the living benefits. And specifically, we're designing these policies to really maximize the cash in it. We in essence want to minimize cost, maximize cash. The way that we do that is by making sure that we as advisors are doing the very best job for you. In other words, we're going to strip back the commissions that we get, and make sure that we can pass forth that benefit to you as the investor. And by doing that, even in the first year, I'm going to have 80+% of my dollars available to use for capital investment. So in fact, there's a lot of investors that we work with who will put money in, take money back out a couple weeks later, and go out and do their deals with it. So it's really a concept that we don't have to wait 5 or 10 years down the road to start utilizing. We can start utilizing it almost immediately. And there's
let me just add to that point here, because this is really important what Christian is saying here, because this is Buck, if you are like me, you heard when you finished your training or you just got out of school and somebody was giving you advice, they'd say, don't buy whole life insurance. Whole life insurance is not something that, you're gonna definitely get a higher return in the market. But you know what? If you did it the way that the Dave Ramseys are talking about and the way that most people think about it, you're absolutely right. That is not what this is. This is a vehicle that is wrapped around with a whole life policy, but ultimately this is a banking mechanism. And I want you to keep an open mind about this, because I have to admit, the first few times that somebody mentioned this concept to me, I was like, whole life, you'd be crazy. I was told a long time ago that I'm not supposed to invest in whole life. And that's not the point. The point is that we're using whole life for a strategy. So keep an open mind as you listen to Christian here. This is a completely different concept and animal.
Thanks, Buck. And really, I should just add one more piece that I think is important. You'll also see out there in the marketplace that there's more than just the whole life product that can be used for this banking concept. We're going to be focusing on that primarily because in general, that's the way we recommend to go. But I just want to at least reference and acknowledge that there's other types of policies that people are using. Okay, so that said, I want to just hit on some of the really core benefits of the policy itself, and then we're going to spend the rest of the time, the bulk of our time, basically understanding how it can help us as investors become more efficient and enhance the things that we're doing already, right? So the idea here isn't to replace the investments that we're already doing. The idea is to really enhance those things, and we'll get into that more here in just a minute. But there's a handful of really important benefits. So the first one I want to hit on is and one of the questions I normally get is, well, how do I actually grow value inside of a life insurance policy? And specifically with whole life, we're going to be talking about guaranteed interest rate, and we're going to be talking about dividends. We'll get into that in more detail here in just a minute. The other couple of things that are really critical and important is that we have a unique ability to get to the money, because the money is completely liquid. We're not having to worry about 59.5 rules like we deal with qualified plans like 401ks and IRAs. And that's obviously critical, right? We can't invest if we can't get to it, and we certainly don't want to have to pay the IRS to do that. The other piece is that this is going to grow in a completely tax-free way. So in other words, it's almost, from a tax standpoint, it's built like a Roth IRA. When I make my money, I pay the taxes then, which you could make a strong argument that's just the right way to go anyway, especially based on where the economy's at and the likelihood that taxes continue to increase. But ultimately, once we get that money into the policy, it's going to be completely tax-free the rest of the way. So again, pretty unique, and it really enhances the overall return, especially for a lot of you who fit into this higher income, high-paid professional group that are kind of underserved in a lot of ways. The other thing that I think is important is we're going to get there's a huge amount of predictability. These companies have been around for a long, long time, 150, 160 plus years. So they have an incredible track record of not just paying out the guarantees, but also paying out the dividends on top of that, which, again, when you compare it and look at it in comparison to the market or really any other type of investment, it's created some significant value. And then, of course, as a reminder, that's only part of it, because we're going to take that money, we're going to go invest it in real estate, in hard assets. That way we can really do what Buck talked about. We can double dip. We can create value in more than one place at the same time. The loan provision is really what allows us to do it. And again, we're getting into it in more detail, but it's important to know how that loan works. We're going to peel back the layers and help you understand the actual math behind it, I really believe that it's one thing to hear a concept and understand it conceptually, but there's just so much value and peace of mind that comes from actually understanding the math and knowing how the numbers work. And then finally, it's important to note, just because we are using life insurance, that there's going to be a death benefit, which is always completely tax-free or completely income tax-free. And then another kind of nice benefit that they've added to it in recent years is long-term care benefits, which allow us to use money while we're living for those types of issues. Again, those are just kind of extras that exist there, but our focal point is really on maximizing the way that we build cash so that we can enhance our investing across the board. So with that said, let's move into the strategy. So that's kind of how the product works. Let's move into the strategy itself, and we're going to talk about 5 areas that we can create benefits for the investor. And I'm going to turn it over to Rod to talk about that first benefit, which I think is maybe the most exciting, and Buck hit on it. We're going to talk about the cash flow component.
Yeah, so the first one is cash flow. And just real quickly, before I get into the details of that, let me just give you the lay of all 5 of them, just to kind of create some context. So the first one we hit is the cash flow. The second one is we're going to talk about how we capitalize our policy, our fund. Then we're going to get into taking advantage of opportunities and how that works, kind of the function and the mechanics of that part of it. Then we're going to get into leverage, and as we go, we're going to be using some examples to illustrate this. And then finally, we're going to focus on this concept of velocity.
So these are all concepts I've heard in my listening to Buck's podcast. I listened to you, Buck, and I've heard you talk about a lot of these things. What are some of the reasons that you like things like leverage and cash flow, velocity? What are the reasons why those strategies or concepts resonate?
Well, let's go back to, my podcast is called Wealth Formula. So there's underlying wealth. In my view, there is a formula, right? There's a mathematical concept that allows us to grow wealth faster if we take advantage of it. And if you look across, the wealthiest people in the world, the most, financially successful people, you see that they all use these concepts. Now, cash flow is really, really important. I mean, most people who listen to me are people who believe in the idea of investing and creating multiple streams of income. So that is, fundamentally, that's one of the fundamentals of I think, creating wealth, is creating not only things that are going to appreciate over time, but things that are going to create cash flow for you now. All right. And in terms of the rest, now let's look at the formula of creating wealth quicker. To me, there's a few mathematical components here. And I always go back to this idea of momentum in terms of creating wealth. Momentum in terms of creating wealth, if you look at what momentum is in Newtonian physics, for example, it's mass times velocity. So mass is simply the amount of money that you put into your investments, right? You're never going to make a return on your investments if you don't have any investments. The next thing is velocity. And velocity is a concept that's critically important. Velocity is simply saying that whenever you get money back from your investments, your yield, your return on investment, you're putting that money back into investing again. And the quicker you can do that, the faster that your money grows. And then finally, leverage. Leverage is one of the sort of what I would call the game changers for really creating significant wealth. Leverage is the ability to amplify what you're currently doing. And in the financial world, that's amplifying it using other people's money, whether that's the bank or whatever. And so these concepts, particularly mass, velocity, leverage, are the absolute critical pieces to creating wealth, and something that 99.9% of the people out there don't really think about, and unfortunately will never benefit from it because they don't really know about it.
Perfect. And that's a great lead into our conversation here around the cash flow, and we've separated them out, but they obviously are all very intertwined. And so we'll kind of explain how the different pieces fit into the overall strategy. So from a cash flow standpoint, one of the real kind of mysteries around this strategy, and that, like Christian said, as we peel the layers back, we want to help people understand is how does a loan work? How is it that I'm able to put money into the policy and build up a cash value, and then use that kind of this double dipping that Bug talked about a minute ago? And so what we want to do here is really help you understand how this piece works, because we have on here showing this compound curve, and that's what's happening inside of our policy. We fund the policy, we put money inside the cash value, and as that grows, it's compounding, right? Just like any other account where we're earning a consistent interest rate. I'm gonna earn a little more this year than I did last year, and the snowball effect creates this compound growth curve. Well, because of the way a whole life policy works, and life insurance in general, when I take a loan, the money that comes to me doesn't actually come out of my cash value. It comes to me from the general account of the insurance company. And so, quite literally, I'm dealing with two separate pots of money, which means that the money inside my cash value is going to continue to compound whether I take the loan or not. And so, what we are seeing is that inside my policy, I can create a 5 to 6% net return, net of all the different pieces happening, tax-free. And again, whether I take a loan, I'm going to see that happen. Well, then let's talk about what happens when I do take that loan. So let's say that I have an opportunity to invest in a piece of real estate. It's a $500,000 total in, and what I'm going to do is I'm going to borrow $400,000 from the bank or some other financing, and then I'm going to take a $100,000 loan from my policy for the down payment. So when I take that loan, that $100,000 is going to come to me from the general account of the insurance company. And so then as I turn around and pay that back, what's really cool is I actually get to decide how I pay it back. They're not going to tell me, hey, you're going to pay it back over a certain schedule, amortized. I get to decide that. For this example, we're going to say, hey, what if we pay that back over a 20-year time frame, just amortized evenly over 20 years?
That's a really great point, Rod, because a lot of times when people talk to us, they say, hey, are they going to check my credit? What are the fees and costs associated with borrowing from the general account of the insurance company? And then one of the things we often hear is, why would I want to borrow money from myself? And so this component, this idea of having two pots of money that we're literally taking from, ends up being really critical to actually understanding the math behind it. So I just wanted to point out that as we're going to talk about this compound versus simple interest financial principle, it really is important to understand that we're dealing with two different pots of money.
Perfect.
Yeah,
So,
and to that extent too, again, just to pound away at this. This is a magic slide here, because what it's saying is that your money is going to continue to grow at a compound rate whether or not you borrow it. And when you borrow it, you're borrowing at a simple rate. Your money continues to grow at a compound rate even though you've borrowed it. How is that possible? Money that you've taken out is still growing at a compound rate. And in the meantime, the simple rate, which is always going to be easier to pay down, is what you are borrowing and deploying into a completely different investment. So I don't mean to belabor this, but this is the thing that I find completely mind-boggling, and for me was a big aha moment when I finally figured out why this was such a big deal.
yeah, and really what's interesting is when we break it down and we look at the actual interest rates. In our example, we're going to say if we're compounding at 5%, and if we're paying on a loan from the insurance company at 5%. So we call it a wash loan, right? We're earning the exact same as what we're paying from an interest rate standpoint. But in a minute here, we're going to look at the actual numbers of what results. And because when we look at a compounding growing value earning 5% versus paying down the loan on simple interest at the same 5%, then the numbers are quite dramatically different. So let's look at that. The first we're going to look at is our loan. Here we're just showing it's really simplified because we take this $100,000 loan and then we're just paying it back over the 20 years. Well, if we look at the end of the 20 years, how much interest did we end up paying? We paid a little over $60,000 worth of interest. Okay. Now when we take that to on the next side and we show what's happening inside of our compound, our policy, right, the cash value in our policy, those same $100,000 that represent the collateral inside of the cash value stayed in the policy, continue to grow, and they earn this 5% rate compounded. By the end, the net result of that is an additional $165,000 of interest that we've earned. And so again, going back to our visual here, if the compound side represents the policy and the simple represents the loan, well, we just looked at an example where we paid $60,000 on the interest in the loan side, while we earned $165,000 inside of our policy, and that's the power of the difference between these two. Wash loan, all those things aside, when it comes down to real numbers, it's pretty impressive.
Yeah, to me, this is just an incredible concept, right? I mean, again, we're using the exact same dollars, we're using the exact same interest rate. When you put it into math, you put it into real dollars and cents, this is how dramatically different it is. $105,000. And so again, like in that example, why would you use any different strategy? There's really nowhere else that I know of that you can do anything like it. So let's move on to the next couple of really critical and beneficial things that I can get as an investor from using wealth formula banking. The next one that we want to hit on is just that we're building up and utilizing investment grade capital. And what do I mean by investment grade capital? This is money that's incredibly efficient. As we talked about earlier, I can't invest unless I have money, and I have to put money somewhere. Well, what are my choices? I could put money in the bank, I could put it in a brokerage account, and the question is, what are the benefits that I get from that? Well, in the bank, we know that we're getting little to no return, right? We certainly aren't getting any tax benefits. If I look at a brokerage account, I may get a return, but I also may get a negative return, and I'm still not getting any tax benefits there. So what we're suggesting here is that because of the tax-free nature of this policy that we're building out to be maximum cash heavy, we're ultimately creating an incredibly positive investment grade capital position. And then the next piece on that is that we're going to generate a very predictable return. In fact, one of the things I want to do here in just a second is I want to actually show what the dividend history has looked like for one of the companies, which really represents the industry as a whole. But I think a lot of people will be surprised because, again, we talk about these returns, we talk about this 5 to 6% tax-free return, which, isn't a bad return, but probably not making people super excited unless I realize that I can get that 5 to 6% return while at the same time deploying capital in other areas. Okay, so what we have here up on the screen is a history from one of the major mutual life insurance companies. And you can see here that we've got a 50-year history. And there's a couple of things I want to point out here. First off, because interest rates are a little bit lower today, what we're using is what's been a historically lower interest. So the reason I point this out is because we're going to generate a 5 to 6% return even in today's economic condition. And I think about that and I say, where in the world can I go out and get a safe, predictable 5 to 6% return on a tax-free basis? And honestly, I don't know that it exists. In addition to that, a couple of things to point out is if you look at maybe some of the downturns in the market. So for example, if we go to 2008, we got paid a 7.25% interest and dividend rate. If I go back to 2001 and 2, the point here is that this money is completely non-correlated to the overall market conditions. And then finally, it's a really fantastic vehicle to combat inflation because as interest rates have been higher in the past, they've also been paying much higher dividend rates. So you can see here through the early 90s into the 80s that we were actually getting double-digit returns. So when we talk about this 5 to 6% return, we're actually talking about a relatively conservative number considering where we've been at in the past. And that's really reflective of market conditions as a whole.
Can you talk a little bit about, this is, I have a lot of doctors and dentists, people with a significant amount of liability and exposure. Can you talk about this, the role of this, from a asset protection standpoint?
Yeah, that's a great point. It's unique. The policy is just unique. It's completely creditor protected from things like lawsuits, financial liabilities. And so from a state to state standpoint, it differs slightly, but really every state has significant creditor protection. I think this is important because, of course, as our not just our income, but as our assets, as our net worth continues to grow, we're also increasing exposure to potential liability. And so in essence, we're building money inside of a vehicle that has, again, a unique amount of creditor protection. This isn't even if we put a trust around it. We could do some things like that to create an added level, but just in the policy itself, we have this significant layer of creditor protection. So let's take a minute and just jump from how this piece works, and let's go into the opportunity phase.
Perfect. Okay, so now that we've capitalized our fund and we've talked about the reasons why we want to use this particular vehicle, when opportunities come along, we need to be ready to jump. Okay, and so the first piece we want to talk about here is the liquidity. As I have built value inside of my policy, I have access to, and it can happen relatively quickly. So the minute ago we talked about an example where we were financing $400,000 and then using this $100,000 from our policy. Well, what if the opportunity required that I had to have a really quick turnaround? I need to get that money in a week, otherwise the opportunity is gone. Well, I can do that. I can take a loan from my policy. I can have that money in my hands within that time frame. I invest, and then maybe I go back and refinance later.
So a lot of times we really look at this as an opportunity fund, right? A place where we can put capital when the right opportunity is there and strikes. We have the ability to take advantage of it and still do it inside of a really unique vehicle.
And the second point that we want to focus on here, we'll build on what we looked at a minute ago with that dividend rate history. But because this is not tied to the market or to real estate, let's go back to 2008, right? So if I had my money invested in mutual funds or somewhere else, and I'm a real estate investor, I'm waiting for that opportunity to come along. In 2007, there's not a whole lot, right? Because values are so high. Well, when the crash happens, there's opportunity everywhere. But again, if my money is sitting somewhere where I lost value, then I'm just not prepared to take advantage of those opportunities like I otherwise would. Whereas here, because we know, just like we looked at a minute ago, it's not correlated to the market. I didn't lose any value when the whole thing came tumbling down. So these opportunities come along, and I'm ready to jump.
Buck probably knows this as well as anybody. Hey, actually, Buck, I was just going to ask you, maybe talk about the value of having cash in a safe place that you could utilize after we saw the financial crisis and housing rates tumble. I'm just guessing that's an area you have some experience.
Yeah, I was. Without prompting, it just got me thinking about kind of where we are right now as of 2017 here, end of the year. There's a couple things I want to point out here, liquidity wise, and again, obviously I'm a big believer in this type of vehicle. I have a pretty significant policy. It's like $500,000 a year that I put into it, and it's not because I think of this money just going off into space and sitting there for years. The idea is that I know that I can get that money back really quickly. And in fact, I with the one that I have, and I know they're all a little bit different, I'm sure, Christian, but my policy is with Penn Mutual, and they just required me to have the money in there for 30 days before I got pulled out my cash value. Now, in fact, I didn't pull it out right away. Why? Because there wasn't a lot of opportunities right now. And there isn't, because there's a sort of a bubble market out there for real estate, et cetera. And to your point about safety, where are you going to keep that money while you're waiting? Right now, there's an opportunity, I think, and if you listen to me, you listen to Robert Kiyosaki, you listen to a number of people, we all think that there's going to be some great opportunities coming up as the market's correct. So we talk about trying to keep some dry powder around, right? Dry powder meaning having some liquidity around so that when it's time to, go in there and swoop in, when there's blood in the street, I mean, I hate to say it, but that's how people make money, like really get wealthy, is when there's a big correction, you come in and you sweep in and you buy up stuff. Well, you have this source of liquidity effectively sitting there growing at a compounding rate of 5% that's tax-free, which is a tax equivalent of probably 8% for most of you, 8 or 9%. And then you just come in and it's in the incredibly safe vehicle. Again, my insurance company is Penn Mutual, which has been paying dividends since established before the Civil War. Now, how many bank failures have you had since the Civil War? You've had an awful lot of them, and they've been paying dividends throughout this entire time. This is safer than a bank, and it's paying you more than a bank, and it's in an unbelievable place to store money, not only for the double dipping, but just for safety and liquidity as well.
Yeah, that's a fantastic point. Normally when I meet with people on a one-on-one basis, I really heavily emphasize this idea that it just is remarkable that we're dealing with an organization, a company that's been around since the mid-1800s, and they paid dividends through world wars, through the Great Depression, through obviously the financial crisis and a variety of other market conditions, and really, just the reality is we can't find that anywhere else. So it is pretty unique from a safety perspective as well. And like you mentioned, Buck and Rod as well, just a great place to store money so that when we have an investment opportunity, we're ready to take advantage of it. But when we don't, we're not just letting it sit and earn nothing in the bank. So really valuable from that perspective as well. The next thing I want to talk about is just this leverage component. And maybe to hit on this first, like leverage in and of itself is something that we're all really familiar with, right? Because we use it even if you haven't started investing and that's something you're planning. Maybe you've just even purchased your own home. Well, most people don't just plop down a few $100,000 to purchase their home. Rather, they get a loan on it, right? Well, what's the value of that? Let's just say theoretically that I had $100,000 that I wanted to invest. And I certainly have the option to go find a piece of property that I just put $100,000 into. And if I do that, it has the potential to be a good investment. I'm going to earn value or earn appreciation on that property as the property goes up. Well, what if, and we all know that we can, but what if I could take that same dollar or that same $100,000, split it among 4 houses or 5 houses? Now I have the ability to create appreciation and potentially cash flow if I rent it, but I have the ability to create appreciation on $400,000 rather than on a single $100,000. This is really an important factor, and really everybody that I know that has a high net worth has built at least a portion of their net worth on utilizing this concept and strategy of leverage. So we want to make sure to the extent possible we're taking advantage of those exact same things. And in fact, I'm going to take this a step further in this example where we borrow $100,000 and relate it back to the policy itself. So let's just say that I decided I'm going to borrow the $100,000 and I'm borrowing against the policy. And remember, I didn't say from the policy, I'm borrowing against it, because what that means is I'm taking money from the general account of the insurance company, and therefore my money, the money I've put into it, still sits there, continues to earn a 5 or 6% return. That's going to stay there no matter what. Now all of a sudden, I go take this $100,000 out, I use my leverage component to create appreciation on 4 houses. Well, I might be getting a 15% return or a 20% return on those actual real estate properties. And by doing that, not only now have I created the benefit from the investment, not only have I gotten the return on the investment, but I've also gotten that return on the underlying cash value that's still in the policy because I borrowed against it rather than taking cash out of the bank or some other place. And so in a very real way, we're literally earning interest in 2 places. And that goes back to that original concept we talked about of cash flow. We also have the ability to utilize that positive arbitrage to create money in a unique way that we just probably never thought possible. And really, it's one of those things where if you look at it over a singular year, you might not see a huge benefit. And yet, if I look at it over 10, 20, 30 years, I can guarantee that if Buck looked at it over long period of time, he'd probably be in the 7 figures as far as dollars and cents go, and how much more money he could have. And so if I asked you 30 years down the road, would you rather have an extra $1 million in your pocket or not? You knew you were going to invest anyway. Why not have the extra $1 million in your pocket? So this concept,
and I think
again,
just to hammer this home, I think the bottom line here, folks, is you can either have your 15, if you're a cash flow investor, you hear in this scenario, you can either have your 15% return, or you could have 15% plus 5 to 6% compounding. I mean, come on, right? Are you going to take just the 15, or are you going to take the additional compounding return? To me, that's why this is such an absolute no-brainer if you're a cash flow investor. It's that simple.
Finally, we're going to talk really quickly about velocity, which just means that we're keeping money in motion. And in essence, when we talk about velocity, we want to do this again and again and again. So this policy that we're creating here isn't a standstill vehicle. This is really money that we want to keep in motion. We want to continue to look for opportunities to invest. We want to put that money into the investment. We want to cash flow it back into the policy and do it again. And just so you know, there's a question I get pretty frequently. There's no number of loans I could have. So I might take a percentage out of my policy for one investment and have another one going on the other side. I mean, I could have 5 or 6 loans going out in order to create this velocity and cash flow that continues to build wealth in a really unique way that, again, I'm just not familiar with anything that really comes close to it. So maybe just to kind of finalize or put a bow on or conclude the core concepts that we've talked about, the wealth formula banking strategy is about creating value with our investing because we were doing it anyway, right? Buck hit on this before. Would I rather get 15%? Or would I rather get 15 plus the 5 or 6 that I'm earning inside the policy? It's kind of a no-brainer, right? In essence, what we're doing is we're replacing the bank for active investors and giving them an opportunity to create extra money, extra value in a way that, again, we just couldn't otherwise. So that's pretty much what I wanted to hit on. And of course, as we talk to people individually, we'll get into more of the math and the details. But as far as the core concepts, I think we covered the most of it. Buck, do you have anything to add?
All right, guys, this has been fantastic. And, I just want to tell people here that, this is a concept, again, that I think is really, really valuable. Who is it for? I mean, this is really for cash flow investors, right? I mean, that is the value here. And I'm a cash flow investor. And so this is a really, really important concept for me because I'm going to do the same thing. I'm going to invest in the same things. This just allows me to make more money. That's really what it comes down to. And obviously there's all sorts of other benefits that Christian talked about. But, I want to point out to you, it's important for you to know that I have one of these accounts and I fund about $500,000 per year. And the reason I do that is not because I'm just sitting there saying, okay, goodbye, $500,000, I'll see you later. It's because I know that's about how much I'm going to potentially invest in cash flow investments per year. Now, you don't have to do that. You could literally be $50,000 instead of $500,000. You could be $20,000 a year. This is not just for people who've got a lot of money. But I mean, so understand that. But the point is that I'm all in on this. And, I think this is just a phenomenal way to amplify money. And so hopefully you'll take advantage of it. And at the very least, make sure you set up a consultation with Christian and Rod, who I think are really the best in the business when it comes to this stuff. So guys, again, thanks so much. And if you're interested in talking to them, make sure that you click on the button there that'll basically notify them that you want to do a consultation. Again, thanks a lot, everyone. This is Buck Joffrey with Wealth Formula Podcast, and hope you enjoyed this webinar.